In 1956, a young Jewish investor named Walter Schloss received a letter from a potential client asking what his investment strategy was. His response was so strange that the client almost decided not to invest with him. Schloss wrote, "I buy companies that are so undervalued that even if the business went out of business tomorrow, I would make money selling the assets." The client thought this sounded too conservative, too boring. 50 years later, Walter Schloss had consistently outperformed the market with a record few professional funds have ever matched. His strategy wasn't in any college textbook, but it was deeply rooted in Jewish investment principles that have been passed down for generations. Business schools teach modern portfolio theory, discounted cash flow analysis, and complex valuation models. That's all well and good, but there are other strategies that Jewish families have used for centuries to build and preserve wealth. Strategies that never appear in the curriculum because they can't be reduced to mathematical formulas. These are strategies that require fundamental mindset shifts about what investing really means. The first strategy you were never taught is something that sounds almost ridiculous in the modern investment world. Invest only in things you can touch or fully understand. In an era of cryptocurrencies, complex derivatives, and structured financial products, this strategy seems primitive. But traditional Jewish investors follow it religiously because they've seen over centuries that the biggest losses come from investments no one really understands. This strategy doesn't mean investing only in tangible real estate. It means that before you put a single dollar into any investment, you must be able to explain the business to a 10-year-old and have them understand. If you can't do that, don't invest, no matter how promising the projected returns. Sam Zell, one of the most successful real estate investors in history, has a personal rule. If after researching a business for a week, he can't explain in 3 simple sentences how it makes money, he's not investing. This strategy saved them during the 2008 financial crisis. While sophisticated funds collapsed because they had invested in financial products that even their own managers did not fully understand, traditional Jewish investors, with their boring portfolios of real estate, family businesses, and simple stocks, survived intact because they understood exactly what they owned and why it had value. The second strategy contradicts all modern financial education. Pay in cash whenever you can, even when credit is cheaper. Business schools teach that using debt is smart when interest rates are low. Traditional Jewish investors do something different. They use debt only when absolutely necessary and always keep enough cash to pay off all their debt immediately if necessary. Why would they do this when they could optimize their returns using leverage? Because they've learned through painful historical experience that flexibility is more valuable than maximized returns. When you pay cash, you have options. When you're over-leveraged, creditors have options over you. Joseph Sitt, a real estate developer in New York, tells a revealing story. During the real estate boom of 2005 to 2006, banks offered him 100% financing for projects at incredibly low rates. His competitors took that money and bought up everything they could. Sitt, following his father's advice, rejected such massive leverage and insisted on putting at least 40% cash into every project. His investor friends thought he was leaving money on the table. In 2008, all those friends lost their properties when they couldn't make the payments. Sitt not only survived, he bought his competitors' properties at fire sale prices because he had cash on hand. The third strategy is probably the most counterintuitive. Invest at the worst possible time according to the consensus. Schools teach technical analysis, momentum investing, and trend following. Jewish investors do exactly the opposite. They buy when everyone is selling and sell when everyone is buying. But here's the crucial nuance that schools don't teach. They don't buy anything that's falling. They specifically buy quality assets that are falling due to panic, not fundamental deterioration. This distinction is critical. During every crisis, there are assets that fall because they're truly worthless, and there are assets that fall because people desperately need liquidity and sell even their best positions. Baron Rothschild supposedly said, "Buy when there's blood in the streets, even if that blood is your own." But the full version of his strategy was more specific. Buy real income-producing assets when panic drives them down to absurd prices. In 2009, when everyone was convinced that commercial real estate would never recover, Jewish investors like Jeff Green bought prime properties in premium locations for 30 or 40 cents on the dollar. They weren't speculating on a quick recovery. They were buying undervalued income generators that would have value no matter what happened to prices. The fourth strategy defies everything you've been taught about diversification. Have multiple buffers of safety in different forms. Schools tell you to diversify your portfolio across different asset classes. Jewish investors go much further. They create redundant layers of safety that are uncorrelated with each other. This strategy means holding cash in multiple currencies and countries, physical gold stored in multiple locations, marketable skills that don't rely on capital, property in different jurisdictions, and businesses in different industries. It seems excessive, almost paranoid. But when you have a family history of losing everything multiple times, you develop a survival instinct. If you find this video helpful, please give it a like and subscribe to the channel so you don't miss our next content. This strategy isn't just for apocalyptic scenarios. It's useful in everyday situations. If all your wealth is in the stock market and you urgently need money during a market crash, you're forced to sell at the worst possible time. If you have multiple buffers, you can access liquidity without touching your investments when they're down. This flexibility allows you to take advantage of opportunities rather than being a victim of circumstances. The fifth strategy is something that sounds obvious, but almost no one actually does. Invest first in increasing your earning capacity, then in assets that generate money. Schools teach you to save a percentage of your income and invest it. Traditional Jewish investors do something different in the early stages. They invest disproportionately in themselves before investing significantly in external assets. This means spending on specialized education, developing valuable skills, building professional networks, and obtaining certifications or licenses that increase your market value. A young Jewish professional may live more frugally than necessary for 5 years to afford an expensive educational program that triples their potential income. From a return on investment perspective, this is much more effective than putting that money into the stock market. The logic is simple. If you increase your earning capacity from $50,000 to $150,000 a year, you've just created an asset that generates an additional $100,000 each year for the rest of your working life. No investment in the stock market can compete with that return. Only after you've maximized your earning capacity do you aggressively focus on accumulating assets that generate passive income. The sixth strategy challenges the modern obsession with returns. Prioritize capital preservation over growth based on your situation. Schools teach that you must tolerate some risk to achieve returns. Jewish investors take a much more nuanced approach. Your risk tolerance should change based on your current life situation. If you're young and have decades ahead of you, you can take more risks. If you're nearing retirement, have a child who will soon be in college, or are in the midst of a career transition, your priority should be absolute capital preservation, even if it means temporarily diminishing returns. This strategic flexibility is something financial advisors rarely teach because it complicates their standardized models. Michael Steinhardt, founder of one of the first successful hedge funds, had a personal rule. Whenever his life situation changed significantly, he completely reevaluated his risk tolerance, regardless of how well his current investments were performing. When he had his first child, he immediately shifted 30% of his portfolio into ultra-safe government bonds, sacrificing potential returns for the absolute certainty that his child would be guaranteed an education no matter what. The seventh strategy is perhaps the most practical but least taught. Invest close to where you live and in industries you personally understand. Schools promote geographic and sector diversification. Traditional Jewish investors do something different. They concentrate a significant portion of their investments in local businesses and industries where they have direct knowledge. Why? Because when you invest locally, you have asymmetric information. You know which businesses are actually thriving, which areas of the city are improving, what infrastructure projects are coming. You can physically visit your investments, talk to the operators, and see with your own eyes how they work. This information advantage is impossible to replicate when you invest in companies on the other side of the country or the world that you only know from financial reports. The eighth strategy contradicts standard financial advice on market timing. Never try to time the perfect market, but always time your own liquidity situation. The schools tell you it's impossible to time a market, so you must invest consistently regardless of conditions. Jewish investors agree that they can't predict the market, but they can predict when they'll need liquidity. This strategy means planning years in advance. If you know you'll need money for your child's college in 5 years, you start moving that money into safe, liquid assets now. Don't wait until the last minute. If you plan to buy a business in 3 years, you start aggressively accumulating cash now, even if it means missing out on investment opportunities. This liquidity planning saves them from having to sell investments at the worst possible time. Many investors are forced to liquidate positions during the crisis because they unexpectedly need cash. The ninth strategy runs counter to modern investment culture. Invest in businesses where you can add operational value, not just capital. Schools teach passive investing. Traditional Jewish investors prefer investments where they can actively participate in improving the business. This doesn't mean micromanagement. It means investing in businesses where your experience, connections, or skills can make a material difference. If you worked in retail for 20 years and now invest in a chain of stores, you can contribute real strategic knowledge. This transforms your investment from a passive bet to an active partnership where you are creating value, not just betting on it. This strategy explains why so many successful Jewish investors focus on specific sectors where they have deep expertise. They're not diversifying widely. They're relying on their own knowledge and ability to create value. Leonard Stern built an empire focusing almost exclusively on commercial real estate, not because it was the only good investment, but because it was the sector where he could add more value than anyone else due to his decades of experience. The 10th and final strategy challenges the modern notion that investing is a one-on-one game. Co-invest with people smarter than you and structure deals so everyone wins more if the outcome is better. Schools teach independent analysis and solo decision-making. Traditional Jewish investors actively seek out smarter partners and structure deals where incentives are perfectly aligned. This strategy has two critical components. First, humility to recognize when someone knows more than you. Second, deal structures where you're not betting against your partner, but rather betting with them. Stephen Ross, founder of Related Companies, attributes much of his success to this strategy. On each major project, he deliberately seeks out partners who know more than he does about specific aspects. The best architect, the best builder, the best operator. He then structures deals so that these experts earn extraordinarily if the project is extraordinary. This alignment of incentives has created a track record of execution that few developers can match. The most profound difference between what is typically taught and Jewish practice is that schools treat investing as a mathematical exercise. Jews, on the other hand, treat investing as an art of living well that integrates your financial situation with your values, your stage of life, your specific knowledge, and your multi-generational goals. If you found the video helpful, please give it a like and subscribe to the channel to continue learning about investment principles and share it with someone who might find it useful. See you next time.